Welcome to Dad Gives Advice. My name is Orestes, and today I want to talk about financial advisors. I've mentioned financial advisors several times in my videos, and I even have a disclaimer at the end of some of them that says you should look for a financial advisor if you're wanting to invest money, because the information that I provide is generic, and you really should work with a financial advisor in order to fit your portfolio to your specific needs. But I haven't talked about what kind of financial advisor you should look for, so I thought I'd put this video together to give you some advice on selecting a financial advisor. In my opinion, you should seek a fee-only fiduciary advisor. And fee-only means that they're going to only charge money based on the portfolio size. So based on what they call the assets under management. So the only money that they make is based on a small percentage of what it is that you have invested with them. Fiduciary means that they have your best interest in mind and not theirs or their firm's interest in mind when making investment decisions. We can contrast that with other kinds of financial advisors that are out there that are both fiduciary and, in a sense, sales folks. So when you go look for an investment advisor and you're not aware of this distinction, you might sign up with one that will say that they're a fiduciary and they say that they have your best interest in mind, but somewhere in the contract or somewhere there's a waiver or a separate piece of paper that you sign that says that that financial advisor can also sell you products or can also be paid a commission on financial products that you buy through their firm. That is not a fee-only advisor. That's an advisor that might charge you a small fee to be your advisor, but will also make commissions on things that you buy through their firm. Now, many of these folks will tell you that there is no conflict of interest, that they are always looking after your best interest, and they would only put you in these different investments that only they themselves would use. But I think that's a clear conflict of interest. If somebody is signing you up for a financial product for which they are making several $1,000s, let's say you decide that you want to put, with your financial advisor, you're going to put $50,000 into a fund that they have essentially sold you, and that fund charges a 10% fee up front, then immediately your $5,000 is going to turn into $45,000. And of that $5,000 that was taken off the top as a fee, your advisor might get $2,000 or so, or the firm might get $2,000. The company that is marketing this product might get the other $3,000, right? Or maybe the other way around. Maybe your advisor got $3,000 or more from, again, selling you this product. Now, these products might be okay. They might, in the long run, do okay. They may grow a good amount of money, and your portfolio may grow as a result. But your portfolio now is starting from this 45,000 base and not this 50,000 base. And that's important because, as these things grow, let's say 10% year over year, over time, your end amount of money that you get is going to be lower over here than it is over here, than if you had the full $50,000 invested rather than, 50,000 minus that commission. So clearly this is not in the best interest of the investor. It's in the best interest of the advisor. And that's not a fiduciary. But again, some of these firms will say, no, this is on the up and up. It works. We've done it this way for years, and that's just the way it goes. I say avoid firms that use advisors that will make money from selling you financial products. Go with the fee-only fiduciaries. The way that fee-only fiduciary advisors make money is, again, by charging you a small percentage of your portfolio that they have under management. So let's say if you invest $100,000 with them, they're going to charge you 1% per year, and that's it. So that's $1,000. That's all you can expect to pay, and they're not going to try to make any more money off of you by selling you products that charge a commission. The beauty of having this arrangement is that their goals are aligned with your goals because their fee is based on the amount of money in your portfolio. So their incentive is to grow your portfolio. So if next year it's grown to, now this is going to be a large growth example, but let's say it grows to $150,000 in the following year, that 1% now became $1,500. So now you see their fee went up because your portfolio went up. So again, your interests and their interests are perfectly aligned. If the portfolio happens to drop in value, their fee will drop in value, and they'll try to work hard to make sure that doesn't happen again. When you look for a fee-only fiduciary, they are likely going to be called an investment advisor representative working for an investment advisor firm. The firm is going to be typically registered either federally or with the state. And the IAR, the investment advisor representative individual, is going to be registered with the state. And that's important because these people and these firms manage several hundreds of millions or even billions of dollars of people's hard-earned money. So they're going to want to make sure that they're well regulated and they follow all of the state and national laws. And that's what these registrations require them to do. In some cases, there will be investment advisors that are not registered in a particular state because they're working under what's called the de minimis rule. And the de minimis rule just simply means that if you have a small number of clients in a particular state, you do not have to register because it can be costly to register and have to go through all the hoops and regulations that you have to do once you are registered. So states allow for a small number of clients until you get to a point where you have enough of a critical mass in the state that will then be able to help you cover the costs and fees associated with being registered. Whether they are registered or not, they're going to fall under all of the auspices of all the applicable federal and state laws, and they're going to be subject to all of the different anti-fraud regulations and other rules. Advisors who run afoul of securities laws will face heavy fines and imprisonment depending on the violation. Make sure that your advisor has passed the applicable state licensing laws, and in most cases those are going to be the Series 65 or the Series 7 and Series 66. So either this one, which is a long exam that encompasses a little bit of each of these, or both of these together. Some states will say, no, you have to pass a 65. Some states will say you can do either a 65 or a 766 together. You should also ask for examples of their portfolio management. They may not be able to give you an exact portfolio with a client's name. They can always give you an example portfolio without a name to show you how they performed over the last few years. Keep in mind that if there has been a down market, of course, they may show you a portfolio that went down in value, and that could happen because, these things don't go up year after year. Sometimes markets go down and there may be down years, and hopefully there's more up years than down years, but again, with investment, there is no guarantee. However, you should look and compare to market indexes. If the advisor is showing you a portfolio that is mostly in stocks and has a growth goal and there's no bonds in there, they should be at least tracking something like the S&P 500 index or close to it. And hopefully if they're charging a large fee, they should be exceeding the index. So if the index, let's say, went up 1 year 30%, and the client's portfolio that he's showing you as an example only went up 20%, then, this is client right over here, then you should be asking why that is. They should at least try to be matching the 30% performance of the index. If they only made 20%, there should be a very good reason. And if they don't have a good reason, that could be a reason for you to not use that person as an advisor. In down markets, if say the S&P 500 dropped 20% in a given year because it was a bad year, but the client's portfolio dropped 30%, that's another red flag. Why did that happen? You should question that. If they have a good answer, maybe you still go with that person. If they don't have a good answer, maybe you look for a different advisor. Be prepared to share some personal information with your financial advisor. They're going to want to know a lot of personal, private information. Think of them as your financial doctor. Like you share a lot of private, personal information with doctors that you wouldn't share with a friend or even some relatives. So you're going to want to do that from a financial perspective with your financial advisor. They're going to want to know your household income, your debts, all your assets. This will help them figure out your net worth. Children, and their ages, your age and spouse, desired retirement age, what your goals are for investments. Are you investing for retirement? Are you investing for your kids' college education? Are you investing to buy a house? When do you want to buy this house? These kinds of things. Your current investment holdings are important because as they're putting together a portfolio that is diversified, they're going to want to know what you are currently holding so they're not getting into securities that are similar to the ones you already have. They're going to also want to know your investment experience. Are you new to this? Have you ever made a trade of a stock or bought a mutual fund? Or are you an expert? Have you traded options? Have you dabbled in Bitcoin or what have you, right? Or somewhere in between. They're going to want to know what your risk tolerance is. And that's so that they can get an idea of how well you deal with volatility in a portfolio. Some people can deal with their portfolio going up and down and swinging wildly 20-25% from month to month. And as long as over the long term, things are in a positive upward direction, they're fine. And some people can't handle the roller coaster ride. They want to see a kind of a slow, steady pace rather than huge swings. And they're going to want to know which type are you, or maybe you're somewhere in between. And also, of course, your time horizon. And time horizon goes along kind of with goals. If all you're investing for is retirement and you're in your 30s, you have a long time horizon. If what you're investing for is your kids' college education and they're 5 years old, that's a longer time horizon than if they're 15 years old. So again, they're going to need to know all these details. Once they have this holistic view of what is called your financial condition, they're going to put together a proposal or perhaps several options for you to review together. And then once you do that, you'll be able to settle in on a path forward and a plan for investing the money that you want to invest with this portfolio manager. You should be aware that you will be signing a contract. So there is a contract involved, then that is required by law. And the contract will state that this person is going to be managing your money. It's going to state what their fees are. It's going to declare in there whether or not they're going to only charge a fee related to the assets they're managing, or will there be potentially other fees and commissions involved, and those are the ones you want to avoid again, but they'll be in there if you go with a different type of advisor. And there'll be other kinds of things in the contract. It's a lot, and I don't have time to cover it here, but you can look up advisor contracts online and see the kinds of things that are in there. The contract will be for a set period of time, which will have to be renewed. So you might sign up for 1 or 2 years, and after that you can review the performance and review whether you still like working with this person and decide to renew or move your portfolio to another advisor. Once the contract is signed and you have transferred the money into your account within their purview, and that's important to note too, that when you sign up with a financial advisor, the money is still an account that is under your name. It is just that that financial advisor has access to the account in order to make trades on your behalf. The money will not go into the financial advisor's account or into the firm's account or the firm that he works for. It'll still be your personal account with a custodian. And make sure you're working with a professional firm and a professional advisor that handles your account in this manner. Once you go ahead and agree with the advisor's plan and they start investing, they may offer you a couple of different ways of doing it. They may say, do you want to go all in the market in the first month? Let's say you're investing $250,000 and you can decide, yep, let's go in. I think the market is at a relatively low point right now, so let's go all in. Quote unquote, it's not going to be all in on one day, but let's say over the span of a few weeks, he or she is going to invest all of the money in the different vehicles that they have decided are best suited for you as an individual or as a family. Or the other option would be dollar cost averaging. And this would be the approach for somebody who is a little less risk tolerant and a little more worried that maybe you're at a market top when you're first starting to invest, and you don't want to put it all in at the top. You want to see if the market drops over the next few months, and put in a little bit at a time. And in that case, you would be using this dollar cost averaging, which means you're going to decide that you're either going to do, like, say 10% or 20% per month as an example, or maybe, per quarter, up to you and the advisor to decide the timing and the amounts. But let's say you do 10% per month. That means that they will invest $25,000 every month for the next 10 months in this example. And then only after that 10-month period is done will all of your cash be fully invested. And that has pluses and minuses associated with it. The plus would be if you're going in at the top of a market and the market starts coming down during the initial period of you investing, you're going to benefit because you're not going to put it all in the first month and then see the value of your portfolio drop over the next few months. The opposite can be true. If you're going in little by little, but the market is going up, you're going to miss out on some growth of the full capital. This tends to be not that big of an effect, or not that big of a deal. If you're looking at a very long-term horizon, it will tend to balance out over time. And that's how you should be viewing investments in markets, is over the long haul. So in the end game, it's not that important that you either went in all in the first month or you spread the money out. But a lot of people feel better if it's done gradually over the next few months as opposed to going all in from the get-go. And once the advisor has all your money allocated into the different vehicles that he or she has chosen, then they're going to monitor your portfolio and make adjustments over time depending on whether they need to rebalance based on the initial formulas that they worked out, or whether market conditions have changed to the point that they need to do something different. And the rebalancing they're going to do is going to happen every quarter, twice a year, or every year, depending on the size of portfolio and depending on market conditions. So that's what I have on investment advisors. Again, I want to say that many of these folks, or most of these folks, are very conscientious and they do have your best interest in mind. But you want to make sure you pick an advisor that is a fee-only fiduciary advisor, that has your best interest in mind and whose goals are aligned with your goals. Somebody that has your portfolio grows, their earning potential grows, and not somebody who's going to be selling you products in order to make money off of you on commissions. Let me know if you have any questions or if you have any other topic suggestions that I should go over. And thanks for watching, and have a great day.